My name is 𝗧𝗵𝗲 𝗥𝗲𝗴, and I'm a professor at the University of Hong Kong. Here, I lead one of the largest online fintech courses in the world. And over the past several years, we've put a lot of effort into meeting with people, talking with guests to try to bring out some of the biggest issues in finance, regulation, and technology. And I'm very excited to announce our new podcast, Regulatory Ramblings, led by 𝗧𝗵𝗲 and myself, from the standpoint of putting together conversations with thought leaders from Hong Kong, Asia, and across the world, looking at the big challenges, the big issues in finance, regulation, and technology. Hope to see you there.
Welcome to Regulatory Ramblings Briefs. Our guest today is Professor Evan Gibson. He's a research assistant professor at the University of Hong Kong, and we're here to talk about his new book, Regulatory Design for Financial Stability in Hong Kong. Evan.
Great to be here, James.
Well, the title of your book, Regulatory Design for Financial Stability in Hong Kong, I mean, post-2008, people are wondering, can you design for stability? Is some degree of instability just part and parcel of the business cycle, of the economic cycle? Or can you...
Well, we find that financial crises are a regulatory occurrence in financial markets. Very large ones are quite rare, say like the 2008 or before that, the one in 1929, about every 80 years. So you might presume that we won't see another one in our lifetime, but we can't be sure. But when we're really talking about medium ones, which can still have a very destabilising effect on particular jurisdictions, these are more common. And we typically tend to find, even in developed economies and jurisdictions, that we have medium-sized financial crises about every 10 years. So they're not one-off events, they're not black swan or rare events, they are fairly regular occurrences. And for that very reason, we need to always maintain a focus on financial stability and the way we regulate financial stability. And this was a particular problem leading into the 2008 global financial crisis, because financial stability as a financial regulatory objective had become de-emphasised.
Very much so. So it's a 15-chapter book, and as I was saying to you earlier, the way you've written it seems to me, irrespective of your interest level or knowledge, or your pre-existing knowledge level, somewhat you should be able to get something out of it. I think for purposes of our audience, chapters 13, China's International Financial Center, 𝗵𝗵 Infrastructure and Cross-Border Reg Tech, and chapter 14, Dollar Sanctions, the Digital Yuan, and Regulating Fintech, are probably the most germane. In the second half of chapter 13 in your book, you talk about cross-boundary Reg Tech against the backdrop of the internationalization of renminbi. You also speak of cross-boundary risks when it comes to clearing and settlement and remittances and the financial instability risk they can pose. Given that there are jurisdictions that rely heavily on remittances and clearing and settlement of FDI, could you flesh out the flavors of those risks, the nature of those risks, and
in relation to
clearing and settlement, remittances, and
so if
the financial stability they pose markets writ large.
I think in that part of the chapter I discussed the use of DLT in that as that sort of basis for financial market infrastructure. So if we think about how we can use distributed ledger technology, or sometimes known as blockchain, for cross-boundary remittances, the technology itself has certain benefits. Payments can be made fairly instantaneously for a start, so that reduces certain risks. There's arguments that blockchains are more secure, so it reduces cybersecurity risks, and essentially you have an immutable ledger of transactions. Now that can also be, that's based on round technology, so that could also be good for also tracing criminality, fraud, etc. in the system. Could be used for detecting anti-money, money laundering and counter-financing of terrorism.
Okay. On page 276 of Chapter 13, you say, regulatory technology is being piloted in jurisdictions with well-developed global financial markets to address the credit and liquidity risks inherent to clearing and settlement systems. Hong Kong has embraced this technology. I mean, is that really the case? I mean, the conventional wisdom is that Hong Kong is often lagging when this technology.
Well,
only just the people that I speak to the market.
There are three instances where Hong Kong has been relatively advanced, particularly when we're talking about distributed ledger technology. We have eTrade Connect that's been operating now for almost 5 years, that's used for trade, it's used for, say, cross-boundary trade, and that essentially uses the technology to streamline the documentation procedures, so it's all kept in one place, there's set procedures, and that's made the whole system a lot more efficient to begin with, a lot more traceable, and so that way you don't have logistics firms, businesses all siloed or dislocated because you have one central database that has brought about efficiencies. That's a technology that's being used based on distributed ledger technology. We've also seen a trial with the northbound Stock Connect with 𝗧𝗵𝗲, which is being used to streamline settlement, and there's also been trials for cross-border payments using the central bank digital currencies, the Lithium Lion Rock,
correct,
with Thailand, and that's evolved now to a multiple CBDC platform. So in those regards, you think about that and the uses of the technology internationally, Hong Kong has been sort of at the cutting edge of utilising distributed ledger technology compared to a lot of countries, particularly in terms of cross-border applications. We see some countries using the technology for their trialling or their use of central bank digital currencies, but it's typically used on a retail or from a domestic perspective rather than a cross-border perspective. So in that regard, Hong Kong is quite cutting edge.
That is correct. Hong Kong has made advances in certain discrete areas, but
yes,
they'd like to see go more widestream, more mainstream. Okay, what's on page 276 of Chapter 13 you say? Regulatory technology is providing new and innovative means for supervisors to manage regulatory compliance and the stability of financial institutions and markets. Market participants use RegTech to augment efficient and sustainable compliance in ever increasingly complex regulatory environment. So, I mean, for me, I could really sink my teeth into this, given my interest in compliance matters. The great concern seems to be that the regulatory system here is not up to par because there are too many regulators who are former lawyers, accountants, and bankers, and not enough engineers and coders. Do you concur? And also, what will such technologies mean for compliance officers? Will they have to re-educate themselves and learn new skill sets?
Well, I agree. The thing is, with technology permeating financial markets and they're really starting to, everything's becoming more online, more digitalised, it means that will have flow-on effects for how they're regulated. And of course then, we see this in terms of RegTech, regulatory compliance being the way that the private sector, financial institutions meet their compliance obligations. They use technology like AI, automation to say comply with anti-money laundering, counterfeits and financing of terrorism because of the burden so onerous beyond human capacity. And likewise, we see that therefore as a flow-on effect of that supervisors have to use their SupTech, supervisory technology, to process all those transactions. So the direct consequence of that is that you will need more coders, more engineers and more people to help facilitate.
More techies.
Basically. Yeah. But the big mistake that I think that could be made is that they'll just get one group and say, okay, you've got to do all these different areas of regulation, and I think that would create a lot of problems, which I highlight. I don't highlight that point, but I highlight that from a conceptual point of view, why that is a problem. So why is that a problem? Because you want to have the various regulatory objectives, the regulatory functions, the regulatory skill sets aligned. So in that regard, you'll need all your techies to be trained to understand what area of financial regulation they're involved in, whether it be financial stability, consumer protection, anti-money laundering, market conduct. And therefore you'll also want them, they'll have to work equally with the financial regulators, being the lawyers, bankers, accountants, whoever, and have them so they are also educated to understand from a very, have some understanding. We're not expecting that they'll be able to actually code or anything or anything more detailed, but have an understanding so they can work together and come up with the best solutions. So the worst thing you can have if you just have one pool of techies working for the regulator and doing all sorts of things. They're not really sure why they're doing it. They're just told to do it, and they might come up with a solution that doesn't actually fit the purpose, and that therefore the bankers, lawyers don't fully understand what they're doing, and you find that you're getting something that doesn't actually work in practice.
So in that sense, it sounds like these have to be techies that have specifically worked in the financial sector. You can't just say, okay, you've got you know X, Y, and Z programming languages. You're in.
Yeah, well,
it seems like context is important.
Yeah, context is important. It would be preferable. It depends, I suppose, on the training that could be provided with the regulator, which goes to resources, which, as we know, they're fairly limited on resources. So obviously some experience in the finance sector would be preferable. Right. But what I'm really getting at is that you need people who can you need to be able to mesh or amalgamate the traditional financial regulators with the techies, who will be like tech financial regulators, and they need to work together on a similar objective so that they can actually produce the technology that will produce the desired outcome. Because otherwise you might find that you get a disconnect and it doesn't do what it seeks, or it does it in a way which is regulation light. Right.
Clearly we're talking about the intersection between law, technology and finance.
Yes.
The regulators would say, okay, the techies, they may have some knowledge of the markets because they worked at a bank, but do they really have that legal mindset, that knowledge? Do they have that regulatory knowledge? Do they have that investigative mindset? And by the same token, the techies would say, it's easier for me to come up to speed on that than it is for you to become a techie.
Exactly, but that's why they need to work together, and focus on specific areas of, in terms of the financial regulatory objectives, because that way it will make them easier to sort of collaborate and to come up to speed, so to speak, exactly what's required of them. If they're just in a pool and they're being hit by, okay, the AML people, they just want some sort of program to detect suspicious transactions, market conduct, okay, disclosure of information on that, financial stability, okay, we need you to move away from, say, something that's based more on behavioural economics to quantitative analysis. I mean, they might be doing all sorts of things. They're not really, they're just being told what to do, and they're sort of, okay, they're not really on the same page, they're just sort of, going through the motions, doing what they're told. Whereas if they're working with, say, a banking regulator, okay, we need to monitor all the capital, liquidity, leverage requirements of these banks based on their ongoing financial reports. Can you do this? And they're doing this all the time. They're talking about this all the time. So what they're doing, they will get a more deeper knowledge in that area, and hopefully the idea is that therefore they'll be more effective at their job.
So what do you see, broadly speaking, is the benefits of wider implementation of DLT systems?
DLTs, we have to understand for a start what it actually does in financial markets. So DLT, distributed ledger technology, sometimes referred as blockchain, it essentially would work as a form of what we call financial market infrastructure. So we think about that in terms of payment systems, stock exchanges, etc. And so that would be its application. So then we have to look at its design, what are its advantages, and how could that be applied to various areas of financial regulation. And so we see it's a ledger, it's an immutable ledger, say a database. Depending on its design, it doesn't necessarily have to be immutable. Depending on its design, you have different types of blockchain. Just to keep it fairly simple for our audience, we just presume it's immutable, it's a database. Okay, so you've got all the data there. If it's used as a central platform within the financial system, if it overcomes, say, different silos, or the way, say, financial institutions, if they sort of maintain a lot of their sort of their information data in-house, they're only sort of releasing what they need to because of their compliance obligations. If you replace that system with, say, one centralised distributed ledger technology, then you could find that you'll get a wealth of information in this particular technology, and then we can use RegTech to analyse that information to detect not only, say, financial stability, risk concentrations in trading, etc., even things like criminality, fraud, terrorist financing, so for money laundering, counter financing of terrorism, to things like conduct breaches. Are they sort of engaging in sort of transactions that may not be sort of, which may introduce new risks or may erode trust and confidence in markets?
Speaking of risks, what one of our viewers wants to know, will the arrival of a digital yuan pose regulatory compliance and market risks?
Well, the digital yuan, the way it's being used at the moment, it's being used as a sort of a domestic level. So it's just being used, it's being trialled in the mainland. We see the system is that distributed ledger technology has not been adopted. The central bank, the People's Bank of China, which is responsible for obviously monetary issuance with the renminbi and the yuan, and also monetary stability, they are issuing the digital yuan. They're using, I think, 6 banks and 2 virtual banks to distribute it through. But then if you, as a citizen, want to make payments or receive payments, then you have to use a payment platform, and typically we see that with either Alipay, WeChat Pay, or Union Pay. And so we have quite a lot of layers. So the risks from a purely a domestic perspective is that, for a start, governments want it to be widely adopted. What's the point of introducing a new technology if it's just going to be a novelty? So they prefer that the digital yuan be widely adopted to replace cash, because obviously cash has been used for such a long time. Everyone is familiar with cash. It's a very simple token-based system. Token-based, you don't need any identification. Obviously has risks, because if you carry cash, it can be stolen. You can be mugged for someone wanting to get it. It can be counterfeited. So then some of the risks is digital yuan overcomes some of these inherent risks. But then when we really look at digital yuan, it's not a token-based system, it's an account-based system. So what does that mean? It means that you require some sort of identification to use it. And as I've just stated, you need to, on the mainland, you need to open a bank account. You need to also have a payment system. I have a payment system with Alipay or WeChat Pay. You have to identify who you are, essentially, and connect it to your bank account. That poses the risks, because you're using private sector infrastructure. You're sort of reliant on their security protocols. Will they have a cyber breach, and then your personal details will leak? Your banking details, your payment details. There's also people, though, show a lot of concern with the government being able to therefore identify who you are and what you're using your money for. Now, the counter argument is, particularly on the mainland, it operates on a system known as controlled anonymity. So that is to sort of have the digital yuan operate more like a token-based system. So in that way, people can't be identified. So what does that mean in reality? It means that the People's Bank of China, the regulator responsible, is only really getting information on broader payment flows for financial stability reasons, etc., and maybe to identify unusual payment flows that could be related again to criminality, etc., national security risks. Controlled anonymity means, though, if they do detect some sort of criminality and they want to actually find out where it's coming from, then all they really need to do is contact the bank, or more precisely the payment provider, who can then therefore identify who's doing what, and then they can identify who you are. And that's the sort of that's a risk for the adoption of it to become universally accepted, because then people have privacy concerns, obviously, on this.
Yeah, the needs of law enforcement versus
the cyber security, privacy. So
These are recurring.
And then if the thing is, if the digital currency isn't widely accepted, it sort of lacks the sort of the liquidity, the confidence and trust, and that can then impact on financial markets. You may find only certain participants accept it, or if they do accept it, it's sort of under certain conditions, and it doesn't have the fluidity, the frictionless sort of liquidity that's what it's been touted for, particularly when you're starting to use other technologies like the DLT, if that was to be used in its application.
Okay. Something that leapt out at me was on page 283. You write, regulatory technological innovations can nonetheless alter risks. In contrast to legacy payment, clearing and settlement systems, DLTs enhance liquidity because instantaneous transactions eliminate counterparty risk and therefore the need for default fund collateral. Although counterparty risk can be eliminated, this does not infer that the platform is risk-free. Indeed, technology-based risks are introduced by DLTs, such as cybersecurity, cryptographic, consensus protocol breaches, smart contract coding flaws, energy or system outages, scalability limitations, data and operational mismanagement, interoperability barriers, or being inflexible to technology or market innovations. If technology-based risks compromise DLT, for instance, by delaying or avoiding transactions, liquidity and credit risks will be reintroduced to the system. Furthermore, DLT-based systems increase liquidity requirements because instantaneous transactions can produce highly concentrated surges in trading volumes. Is that necessarily the case, though, that DLT increases liquidity and transparency, or is that more of an aspirational goal? That the ideal state of this technology, it can get us to that?
Yeah, well, it's making the presumption based on that if it was used as a type of, within obviously payment system, it's being used as financial infrastructure.
That if it became the default standard, everyone uses it. Yeah.
Because obviously one of the benefits is being touted, and this again depends on the design of the blockchain or the DLT, because certain DLTs can process transactions within seconds. Some take hours depending on, some can take longer depending on the design. But the thing is that, say, presume that you have a permission system that operates more efficiently, say a centralized system, than a decentralized permissionless one that you typically see with cryptocurrency use. And this is a system that's being in the trial so far is being adopted by financial regulators. They use permissioned ones, that way they have more control. And because they have more control, they have less energy usage, and they can process transactions a lot faster. So if this did become the default, you could have a high volume of transactions happening at once. You want a lot more liquidity in the system. If any one of those outages occurred that disrupted it, that could cause a lot of problems within the system.
On page 284, you write, policymakers and supervisors are embracing RegTech tools because of efficiency gains, further deeper reaching supervision and real-time regulation and compliance. Artificial intelligence is a RegTech tool designed to manage numerous routine reporting and compliance tasks. However, AI lacks judgment when confronted by moral and ethical decisions. So would it be fair to say AI works until it doesn't? Is that a fair statement on the limits of any algorithm?
Yeah, well, that is, from a really broad perspective, that is true. The thing is, you've got to understand with when you're using any sort of automation or AI more broadly. We're not talking about machine learning, but if you look at for a lot of financial institutions, they use automation, particularly with things again like to meet their money laundering, terrorist financing compliance obligations. That what they're doing is they're just going over patterns based on sort of historical events and data. The problem with that is that can create, in certain senses, it can create certain biases based on historical data that may not be compatible with, say, new rules and regulations. And it doesn't, again, it can't actually make a judgment. It's just sort of evaluating based on sort of patterns, data, and historical data at that. And that is the problem, is with all this technology that's being introduced, it's not just a silver bullet. There'll always need to be some sort of human supervision over it, because there's always going to be flaws, fallacies, problems. There's going to be disruptions, and AI is no different, because the pure fact is, I think it's misleading. People call it artificial intelligence, so they presume the computer's going to have a brain like you and I, when it's not. It's just algorithms just going through various systems, pattern recognition, etc. It cannot have that sort of that overriding judgment, or even making decisions from a very longer term perspective. It's very sort of more instantaneous, or in the very short term, and that presents problems, as we know, because in financial markets, obviously, when you're regulating the behaviour of people, you're looking at the behavioural economics, you're looking at psychology. Artificial intelligence doesn't really work that well in those areas. You're also looking at things like systemic risk and financial stability that can build up over time, be subtly sort of outside of the regulatory system, undetected, or if detected, just ignored for whatever reason, and they build up over time till they get to a point where they are a risk. And if it's a risk which has not occurred before, which is typical in most financial crises, you have artificial intelligence, automation. They're looking at historical risk. They're not looking for it. They're looking at pattern recognition now. They will miss that until it's too late. Okay. So you need human judgment for all areas of technology, just to always reassess, reevaluate, and just to ensure that nothing's being missed, so to speak.
Well put. Part of the chat, I think, because of all that's going on in the world. Chapter 14. You say that when it comes to sanctions, we should view a digital yuan as a way to fight. Well, when it comes to sanctions, should we view a digital yuan as a way to fight back against greenback hegemony, or is it just one more offering in a global financial system in which assets will be denominated in US dollars for a long time to come?
Well, what we've seen, there's been a very interesting development, particularly last month, where the BRIC nations actually floated the fact that they want to launch their own international reserve currency.
Yeah, come on, do that.
Yeah, and so what we've seen is this is particularly being pushed by Russia, because it's been sanctioned and shut off from the US payment system, and it's getting a lot of sanctions now from Europe finally, even though they had a lot of dependency on their gas. We're seeing China as well being a big driver of this because of the trade war with the US, etc., and then seeing how in the past the US dollar has been weaponized against various countries like Iran, for example, with North Korea. But so they've sort of had an incentive or a motivation to move towards a system that's not reliant on the US dollar as the international reserve currency, to get around potential sanctions, get around being potentially cut off from the SWIFT international payment network. Now, what's interesting with this new international reserve currency is for BRIC nations. So it's not just China, Russia. You're also seeing India, Africa, Brazil, as well as recently all the OPEC members. All 12 countries have signed up to it, as well as a lot of countries on the Belt and Road Initiative, which, if people aren't aware of the Belt and Road, it's the modern version of the Silk Road, except it's greatly expanded across land and water, and it doesn't just spread between Europe and the mainland. It also goes to South America, Africa, etc. So it captures about 75% of the world's population. So this is a big deal. If for a start, just beyond the digital yuan, just from a perspective that if you have two international reserve currencies in play, it really starts to erode the strength or the power of the US dollar, particularly for the US government to sanction countries. So how does the digital yuan fit into this mix? So we've seen that China's been at the forefront of trialling a central bank digital currency on an extremely wide scale, because obviously they have a population of 1.4 billion people. Unlike we see other trials, say the first trial of CBDCs in Bahamas with their sand dollar, very small population, very insignificant economy in the world scale. So we see what China's doing, they're doing this trial. So then we might ask, with this technology, would this make the move to a new international reserve currency somewhat easier, somewhat faster, somewhat more efficient than what would happen under say the legacy systems? Well, an answer would be yes, because the world is reliant on the SWIFT payment system, which is that essentially a messaging platform where different institutions, governments, whatnot, they adjust their balance sheets based on the message they receive. It's trusted. The US government has a lot of power over SWIFT. They can basically order, if they feel that there's enough justification, they can basically terminate a country from accessing the SWIFT system. We see with Iran that caused a lot of problems in terms of their access to finance. If they do get finance, it really increases their borrowing costs. It just has a very dramatic economic impact. So if we have a system that can bypass this, digital yuan might provide that technology. But then you've got to proffer the question. You've got so many nations like OPEC, Russia. Will they trust a digital yuan? So we could see a situation where they use the technology, but they invent a whole new international reserve currency, whatever they decide to call it, that's based on the technology that's been tried on the mainland. And that might be a way then, because the technology's there, the mainland's trialling it, they can, if they think that this has an advantage to them, which it does, because therefore they're not beholden to the US dollar. You've got to remember, even though the RMB, they're trying to internationalise it, it only makes up about less than 2% of all international trade, whereas you have the euro and the US dollar is more like about 40% each. So there is an incentive to create this, maybe to build trust, and we saw this, say, after World War II with the various international organisations for financial regulatory reforms. You may need a separate currency that's an independent currency, independent of all the states, though is accepted for payments by all the states, based on the technology that's being used by the digital yuan. And it would be, and I believe it would also be more stable and have more greater implications for the United States dollar being a fiat currency based on market forces. There is discussion that this new international reserve currency will be commodity based, not backed on gold, or not at least entirely on gold, based on a basket of commodities depending on each jurisdiction. Say Russia's got oil and gas, the mainland's got rare earths, OPEC's oil, certain African countries might have other reserves such as cobalt, etc.
Certainly one doesn't speak in these terms in polite society, but the unspoken subtext is that in the post-gold standard world, the value of the dollar is, to a large extent, backed up by the fact that the US can enforce its will.
Exactly. It's like with most areas of well-developed, well-functioning financial markets, it's based essentially on trust and confidence. And in some regards, after a certain period of time, it's complacency, and I think that's a bit of the problem too. Is we got so
that's in, and we just accept it as the standard.
Yeah, we accept it's been there since 1945, the Bretton Woods Agreement. It was pegged to the gold standard at US $35 an ounce. That was abandoned in the early 70s once it became apparent that the US would not be able to honour its international obligations in terms of exchanging it for gold. And so
fateful day, 1971.
Yeah, and then fiat currencies became the norm. The UK went to one, and we've seen that they've slowly devalued ever since, and it's based all around trust and confidence. It's market based. How much someone's willing to pay for it, how much someone's willing, just if they're prepared to sell it.
It was interesting to hear you bring up the SWIFT Accords, because as I had to remind a room full of crypto enthusiasts some years ago when I spoke at one of the earlier Bitcoin events in Hong Kong, that we talk about the SWIFT Accords, but they came out of Europe. They were crammed down everyone. They became we see it as the global standard now, but it didn't happen overnight. And they became the global standard because it was in an age when America was in the ascendancy in the 20th century, and they were able to cram it down everyone's throats, and voila, it became the default standard. And that brought with it many benefits, certainly. But even, at the end of the last decade, one could see the writing on the wall with China and Russia doing their own thing. An alternate payment route almost seemed inevitable, and now it's, certainly from the perspective of the Chinese, it's a dream given form.
The technology's there. I mean, it just needs they probably still need to trial it for a little bit longer, but you can see that it's not going to be long before the technology is going to be.
As cruel as this sounds, it seems to me that by virtue of, people can talk about whether China's authoritarian or totalitarian, but certainly, but by virtue of their authoritarian system, they can cram down that technology to the point where it filters down throughout society, the digital yuan, thereby moving the concept of such a currency and technology forward, thereby making it more likely it'll be adopted elsewhere in the region. I don't think it's that much of a logical step. I think that if you're going to push forward the implementation of such things in this region, it would seem to be China as key.
Well, obviously because of just the size of the economy yes, and they're influential, but it's not a given, because although you have the authoritarian where they can literally instruct banks.
This is how it is.
But there is still some resilience from the broader populace. There has been pushback. A lot of people have looked at the digital yuan and think, what do I really need is, why can't I just use my RMB? And there was actually a report published on this recently by the Bank of International Settlement that looked at not so much as, it started by looking at sort of payment systems and the way digitized payment systems became widely used as an event of COVID with all the lockdowns and everything. But then they also found that despite that, people still value cash as a safe haven. They're very secure because I think it lacks, it's token based, it's anonymous. I think people like their privacy, they're a bit fearful of governments keeping an eye on them. And this is a bit of the pushback that we've seen on the main as a central bank digital currency. I think people will sort of think, well, cash works. Why do I need the CBDC? Even though it's probably easier for them if it's just a seamless system and it flows through. They don't have to go to ATMs, etc. But there has been some not the ready acceptance that I think the authorities were expecting. There's been a bit of resistance there, and I think you'd have a lot, like somewhere like the US, I think you'd have a lot of resistance. A lot of people might see it as overreach from the government, particularly when they're aware that it has this traceability, it's programmable, controllable, and they suddenly think, well, it's just the government sort of, really wanting to...
Now, what you've described is that's precisely the rationale that for the past decade I've heard from older people in Hong Kong, in Singapore, Asia writ large, of why they're not buying into crypto. That the attitude is, okay, you tell me that Bitcoin's a peer-to-peer system and there's anonymity. Well, they say it's protected by an NSA level algorithm. Techies tell me that those can be broken into.
Well, we've seen those.
Okay, so if they can be broken into, then it's not absolute security. Peer-to-peer system. They're saying if I want anonymity, I can just use cash. To use Bitcoin, I have to go online, which poses risks in and of itself. Then there's a thinking that, I'm safe so long as my Bitcoin are in a thumb drive in my pocket, which is not the case.
No.
I mean, it strikes me that you can't stop progress. There will always be stragglers. But whereas right now, say, if I want my credit card statement in a printed monthly statement, they're going to charge me an extra $20. I think the day will come where they'll be like, no, we're going to send you an email, we're going to send it to you digitally, you can print it out yourself. But it's going to take a certain tipping point. And I would submit to you, it means a certain number of the older generation have to pass on before there is a paradigm shift, mindset shift. people who were born in an age when technology was more pervasive, and then it'll be a cascade effect.
It also depends really on where,
in terms of adoption,
and to demographics, because you're presuming that you'll have a younger, educated population who are tech savvy and won't think twice about adopting this technology because they...
Or who came of age when...
Yeah, but you've also got a lot of people in the world who aren't educated, aren't tech savvy, or just aren't, maybe for whatever reason they don't have the exposure. So I don't think it would be quite like that. I think there will always be a level of resistance. I think obviously there will be greater adoption once, say, an older generation moves on. But you've also got to understand sometimes the technology, you can't just have a blind faith and think, okay, we'll just move totally to technology, we'll get rid of all the old legacy systems, because you'll have certain people who can't, for example, use online banking. Why? Because they might be blind and they just cannot use online banking. So again, it goes back, you need to have humans in the loop. You can't, for say, a banking system, you can't just think, okay, you work for a bank, we've got costs, we can save a lot of costs, let's get rid of all our branches, all the services can be online.
That's what they have to do. The only reason they maintain those brick and mortar branches is because the state requires them to do it.
Yeah, because you've got old people, uneducated people who, for whatever reason, and then you'll have people with certain disabilities or other people for whatever reason, they can't use the technology. So you need to have a certain, you'll be able to eliminate quite a lot, but you'll always need to have some bricks and mortar branches. And again, what I was going to get to was even the online services is why maybe you cannot use this solid automation, artificial intelligence, machine learning, because what if something goes wrong, or what if there's just a problem with the system, you'll need someone there always, and this goes back to what we discussed earlier.
I can certainly see the point where the banks say to people, look, appoint someone who can do this for you, even if you are old, even if you do have a disability, but it's going in the direction of tech. You can tell the signs are there. They want you to use the tech more than burden them with your presence at their banks. And to the extent that they maintain branches, they want high net worth individuals. Those are people that are willing to lavish with their time.
But you say that you want high net. Do you think high net individuals will want to deal with a computer program, or will they want to have a personal relationship?
Of course, they want someone to do it for them.
They want to be lavish. They want to be and so that will necessitate more and more, humans in the loop as well.
Yeah, for sure.
I think the other thing you're getting at when you're saying the thumb drive in relation to Bitcoin, it also goes to show that although you introduce all this new technology and you're streamlining certain aspects, are you then saying to introduce sort of those more legacy problems? Because if you're carrying a thumb drive with your Bitcoin, what's the difference between carrying around a wallet full of cash and you get mugged, or you lose it, or you misplace it, which a lot of the early adopters of Bitcoin said, oh, look, I invested and I had X amount of Bitcoin, it would be worth a couple $1 million now, but I've lost all my codes, or I've misplaced them, or I've misplaced my thumb drive. There's all those common tales you hear. And that's the same as if you invested in a company or something and you've misplaced your,
Sure. But of course, if someone nicks your thumb drive, they don't have your password necessarily.
Yeah, but then you don't have access to it either, so...
Right. And plus digital wallets can be hacked.
Yeah. So, and you trade cryptos on exchanges, and we've seen that exchanges aren't always the safest place because they hold both your keys, and so the way they work. So we've seen frauds to set those up, or we've seen that they've been subject to cyber attacks and huge outages.
The industry has gotten such a bad reputation, but I was going to reverse what I said a second ago. Even though most older people of a certain generation, people born, shall we say, before 1960, seem to be the stragglers, they seem to be the holdouts. I have noticed, though, in this region, certain older people seeing the gains that their nephews and nieces and grandchildren and kids are making on crypto. Willing to put
were making.
Put some of the family's money, give them some of the family's money to invest. And so that's how they're partaking. I don't know if they've got faith in it, but they see an asset, they see a commodity increasing in value, and they want to ride the wave up until it's splashed. But that's what more of them were doing.
Well, for sure. I mean, we've seen you can see there's a direct increase in demand across the board, because what we've seen is now that you're seeing more mainstream financial institutions are offering funds for people to invest. People want exposure. People think, I can make money on this. And if it's legal, and if you've got the spare money, or if you've just got the inclination, if there's a means to do it, you'll invest. And they may see investing in these funds with a legacy sort of investment bank, for example. That's a safer way to go, rather than having to deal with, say, Bitcoin like an exchange and all these other things. They'll let the legacy institution do it, because they'll have maybe the presumption is, which I suppose rightly so, is that they'll have their own security protocols that they'll put on that to protect their clients' funds.
In this town, there is a type of Hong Konger that rabidly chases the easy money, the quick dollar. And for them, depending on when they got in, some of them made out like bandits. I mean, some of them are just living it up to the nth degree that, where are they? Are they in Bali? Are they in Penang? Are they in Phuket? Are they in Chiang Mai? Who knows? But I mean, people you can't get on the phone because they're just it's Scrooge McDuck. They're swimming in riches, and they're living their lives all because of crypto.
Yeah.
And even in Dubai, where the Middle East capital of this, I've seen families pulled out of the working class into the ranks of the middle class, and upper middle class, and wealthy because of crypto. So I mean, it has benefited some people. But this brings us to our final question, page 310. You say cryptocurrency regulatory frameworks have been erroneously designed around consumer protection and market conduct, not financial stability. With the recent growth, volatility, and demand in cryptocurrency markets, neglecting financial stability supervision could precipitate a future financial crisis. Could you please elaborate? Because I mean, I think the watchword since 2008 is consumer protection.
Yeah, there's been consumer protection. There has been, if you look to the way they're being regulated, they're regulated typically, say in Hong Kong, Securities and Futures Commission, security sector regulator.
Yeah.
Main functions market conduct.
And giving you the information to protect.
Yeah, market efficiency, information disclosure. So you have complete, perfect, and instantaneous material information that will affect the price of whatever you're investing in.
Right.
That is different. So that's not financial stability. So what we've seen financial stability, well, we look at the US last year, cryptos are regulated differently. In Hong Kong, they're regulated as commodities, so they fall under the Commodities Futures Trading Commission regulatory sphere. They looked into Tether last year. Tether had at the time a market cap, I think, of 78 billion. I think it's dropped down to 68 roughly, don't quote me, something like that now. Anyway, they were interested because it was a stable coin and it was one Tether to $1 US.
Right.
However, talk to people on Wall Street, etc. No one, if that had that sort of backing, they would have heard of it. No one had done any business, so they instigated a review or an investigation of Tether to find out this. Tether was saying that, yeah, we've got full backing for our stable coin, in terms of, US dollars, never elaborated on it. When they actually looked into the matter, there was less than 3% was actually backed by US dollars. The rest was backed by commercial paper, so short-term debt instruments provided by corporates. A lot of that was high risk, a lot of that was junk and that sort of thing. So, and as we've seen even more recently, if you get any sort of, if people start to lose trust on these sort of coins, you get a run on them, the stable coins, I'm not convinced that any are actually stable because, like anything, regardless of what you say, they basically will be subject to the forces of supply and demand. They perform more like a floating currency. We saw that with Luna a few months ago that lost most of its value. It was a stable coin as well. So how does that feed in? Well, we're seeing the size, talking 78 billion. If they keep growing, keep in bigger markets. At the moment, it's not a problem because when we think about financial stability, we're talking about things like contagion, the way risk can spread through a financial system, systemic risk, the interconnections between the various components of financial systems. So we're talking about financial institutions, financial market infrastructure, financial markets, financial products. You saw financial products like credit default swaps during the GFC. And so what we've seen so far is there's been limited interconnections with cryptos so far. But with these funds that are being licensed by regulators, for example in Hong Kong, these crypto funds, you're starting to create more linkages in the financial system. So if these crypto markets continue to grow, 78 billion, they grow to, I don't know, a few hundred billion, and you have several of these.
They're becoming intertwined.
Yeah. And then if they're getting traded on more of these platforms, you've got to think that people sort of speculate, Bitcoin's going to replace the US dollar. But the thing is, Bitcoin's always quoted in US dollars.
Right.
You always want to exchange it. You said all these people got rich. Do they get rich by just purely Bitcoin, or do they cash those in and got rich? Or they cash them in. So they're connected to payment systems, financial market infrastructure.
Right.
You see, connected to legacy financial institutions. Once those interconnections build, the markets keep growing. If you suddenly get a crash, like what we've seen in the last 6 months, that could be a financial stability event. And that's what I'm saying in my book is they really
crypto could shake markets.
Crypto could, if it becomes interlinked, there's a big enough sell-off, if people start adopting them more, and there could be that complacency could build in if governments start adopting central bank digital currencies and they start replacing your cash, because people might start getting comfortable with central bank digital currencies, and they might then start to view cryptos in a more optimistic light.
Because right now, you talk to...
Not right now, but it's building. I'm just sort of looking for, because that's the very last sentence of my book.
Because the people, you talk to people, the semi-retired types, the older generation, who maybe are managing 20 stocks, and even that can be a struggle sometimes, they tell me. Or the grandmas or retired mothers who are day traders, and they regard crypto as that's what the kids do. There's no sense that this could bring about another global financial.
Well, let me put this into sort of a historical perspective. Say we're sitting here in the early 1990s, and I was telling you that 15 or so years there's going to be an esoteric financial instrument, a derivative, and that's going to cause widespread financial instability. And you'll say, well, derivative markets, they're only futures traded on corn and commodities. How's that going to work?
Yeah.
Lo and behold, we have and from through structured finance, where banks might start to transfer their credit risk off their balance sheets, and they're going to use these instruments as one mechanism that will be supported by credit rating agencies that support this credit risk transfer. And that's going to cause a major meltdown in financial markets, cause the biggest financial crash since the Great Depression. You'd say, well, that sounds pretty far out there, it seems pretty absurd, but we saw that with credit default swaps and the global financial crisis. Cryptocurrencies to me seem a lot more, they have permeated a lot to the wider public, a lot more than credit default swaps ever did. And then we've seen the growth. You said, you yourself have said that people have gone from being working class to being...
But that was a matter of timing. Buying it when he was...
But they're still going up. You still see that, they've gone down now, but they tend to rebound and go up. And what's to say that they just don't keep expanding and building? 78 billion, that was quite a staggering figure, and it obviously garnered the attention of the regulator in the United States. And because they sort of saw the market growth, and they probably thought, well, if this keeps growing, it gets to 300-400 billion. That's what I'm saying. And then you have several of these out there. You've got Bitcoin, you've got Ethereum, you've got Tether, you've got all these other ones. And then all of a sudden you get some sort of market event where everyone suddenly loses trust and confidence in those and pulls their money at once. You've got all these funds that connect financial institutions, you've got payment systems, etc., and it's all getting linked. You start getting derivatives contracts written on these things as well that connect other.
No, but your point's well taken. I mean, those of us that have studied commodities regulation know that even into the 70s, when you were talking about futures, I mean, the Community Commodities Exchange Act, I mean, the CFTC, I mean, their focus was primarily commodity futures. That's how they viewed it. And then they realized in the 70s that, okay, if you took a bunch of currencies and bundled them together and packaged them a certain way, you could have currency in futures. And so I think the point you're getting at is the instruments evolve, and so does the magnitude of risk along with it.
Yes. Yeah. And because if you look at even commodities regulation, if you go back to, say, the 1920s, the 1930s, the way they were regulated, and even in the 18th century when they were regulated, they were looking at ways to, particularly with futures and that sort of thing, to stop speculators, because they realised that this could, unhinge the confidence and trust, the whole purpose of what they were there for, which were just used to sort of stabilise the future prices of these products for farmers and whatnot, to ensure that it feeds back into, because, obviously for national security reasons, that people could be fed in the US and they wouldn't have social unrest or whatnot, or breakdown of society. But it was to eliminate speculators, and a lot of financial regulation throughout a lot of large reforms, particularly around the 1920s, obviously the stock market crash, but that also, what people don't hear so much, is they also had major futures regulatory reforms a couple of years after that as well, to reduce speculation on those markets. So they'd provide a useful function, but they wouldn't become a financial stability risk, or a risk where people would lose confidence and trust in those markets, would not invest in those markets, would lose liquidity, and their functionality would become compromised.
Certainly, when one looks at the Commodities Exchange Act in the US, it was written at about the same time as the 33 securities.
Yeah, I think 35 2 years later.
And in much the same language.
Almost exactly the same, but just to a different market.
Achieve similar goals.
Yeah.
But as students, we study these topics as discrete topics. We study them in isolation. We take securities regulation, we take commodities regulation, and this is how the average person, if they have any even rudimentary financial savvy, they see the price of a security is one thing, the price of a future or a derivative of that security is something else. But as you and I both know, that there are market actors who have more savvy, more sophistication than the average person.
More information.
And they will manipulate one to effectuate a change in the other.
Yeah.
In one market.
Yeah. Yeah. Well, that's the other problem. That goes to market conduct as well. But yeah, and that's a problem. That's an ongoing problem. And we see this in crypto markets. We see this in there has been speculation, or there has been rumours, I should say, might be a better word, that there are some actors in crypto who have very large positions, particularly like with Bitcoin, and they can move the market, and so they do this.
The whales.
Yeah, the whales, exactly. And they do this to profit. So they go down, they'll make money. Goes up, they'll make money, and they and we find, because financial regulators, particularly conduct regulators, particularly in the US these days, it seems to be, some might say, we're in the golden era of fraud, because they're toothless tigers. They'll police some things, but you can really get away with murder. And we see a lot of not only CEOs of companies, or the people who are behind these cryptos, or even market participants, intermediaries. They can get there and literally pump up the prices, put out all this sort of puffery or the sales pitch, the pump, and they're not being properly policed by the financial regulators, and so they're doing this to either make money from a price increase, or then something will happen and the price will go down.
Well, thank you so much for joining us, Evan.
It's been a pleasure, absolute pleasure.
Thank you for joining us.
Thank you.